So the title is Too Good to Be True, Look Ahead Bias in Empirical Options Research. And pretty much what we do in this paper. And so in the finance literature and theoretical literature, it has long recognized that high Sharpe ratio strategies, which you normally call good deals, should not be often present in the data. And that is a point made by academics. So you have an example where there, Cochrane and Sahake, who are actually talking about good deals. But also practitioners point this out. In fact, one of the red flags that Bernie Madoff's fund was, in fact, a Ponzi scheme was the fact that it had, very high Sharpe ratios, too good be true Sharpe ratios, which ranged between 2.5 and 4. Now, when you look at the options literature, however, we find that very high Sharpe ratios are actually somewhat common in the empirical options literature. And what we are trying to do in this paper is to see if we can use these high Sharpe ratios to detect potential look-ahead biases. And how do we do it? So we select a few influential studies in the literature that display very high Sharpe ratios. And then we reproduce the findings in these studies. And to reproduce the findings in these studies, we need to start with the filters that these studies use. And so it's very common in the options literature to actually use filters on the sample selection. And we apply exactly the same filters that the studies that we select use, with the difference that to be able to actually replicate some of these findings, we need to apply these filters not only at the beginning of the holding period, but also after the beginning of the holding period. In other words, some of these filters generate sample strategies that we call infeasible. And they are infeasible because they are based on information that is not available for traders when they put the trading strategy in place. Now, we need to do these infeasible strategies in order to replicate the findings of some of these papers. Without these infeasible strategies, we will not be able to actually replicate those findings. Then we reproduce these findings of these papers, and then we try to emulate these findings using a feasible approach. And a feasible approach is an approach that uses filters that are only applicable at the beginning of the holding period. And then we compare the results that we get in our infeasible and feasible strategies, and specifically we compare the mean returns, t-statistics, and Sharpe ratios. Now, there are two stylized findings that we examine in this paper. The first one is the stylized fact that there are many stock characteristics that appear to be very strongly priced in the cross-section of individual equity option returns. So specifically, Zhang, Heng, Cao, and Tong, ZHCT from now on to abbreviate, study options strategies based on 10 stock characteristics. So what they do, they sort stocks on 10 different characteristics, and they write call options on the stocks that have low value for those characteristics and high value for those characteristics, and they compare the high and low portfolios. And they find that the high minus low in general results in strategies that have very high mean returns and very high Sharpe ratios. And so across all these 10 stock characteristics, they actually find an average Sharpe ratio of 4. The second stylized fact that we examine is related to illiquidity. So illiquidity seems to be very strongly priced in options, specifically Christofferson, Goyenko, Jacobs, and Karoui, CGJK to abbreviate, show that the premium on options illiquidity is very high. And so buying in liquid options and selling liquid options results in returns that are very high with very high Sharpe ratios according to CDJK. So in their paper, they actually find that the average at the money calls and puts Sharpe ratios are 9 and 5. And so that is buying in liquid options and selling liquid delta hedged options. So these Sharpe ratios are extremely high. And so what we do, we try to see if they may actually be a result of look-ahead biases. And so what do we find? We find that these apparent good deals in ZHCT and CDJK are due to look-ahead biases. And so specifically, when we try to replicate ZHCT, what we find is that the monthly return and the monthly mean return across the 10 strategies that they have, we find in our application of a 2.4% monthly mean return, with a t-statistic on average across the 10 strategies of 14 and Sharpe ratios of 3.6. And this is the replication of their strategy, which is based on an infeasible sample. Once we try to replicate their strategy with a feasible sample, that's created only based on information that's available at the beginning of the holding period, these results change completely. With the feasible replication, what we get average monthly returns of 0.4%, average t-statistics of 2, and average Sharpe ratio of 0.5. In the case of the illiquidity results, which is CDJK results, when we try to replicate the results, we find that the average daily return for call options, providing liquidity on call options, is 1.6% per day. And the put returns is 0.9% per day, with average t-statistics of 30 and 18, respectively, and Sharpe ratios of 10 and 7, approximately. This is the replication of their findings, CDJK findings. When we try to replicate their findings only using feasible strategies, the results also change drastically. With feasible strategies, these mean returns, they become 0.1% in the case of providing liquidity for calls, and 0.06% per day in the case of providing liquidity for puts. The t-statistics drop from 30 to 2.6 and from 18 to 1.3. The Sharpe ratios drop from 10 to 0.9 and from 6.5 to 0.5. Why there's such a change? Well, this change is because some of these filters that are imposed on the sample creation, they essentially eliminate options that are far from at the money after the portfolio formation. So options that end up being either deep in the money in the end of the holding period or deep out of the money in the end of the holding period, they are eliminated from the sample because of these filters. And then as a consequence, you have these very high Sharpe ratios and very high t-statistics in the feasible sample, but in the feasible sample, you don't find the same results. Now, the implication for the empirical options literature is that only a small set of stock characteristics are actually associated with options expected returns. So that is a result that is different from that in CHCT. And it's also a result that, so in their case, they found 10 characteristics. In our case, we find that only 3 characteristics are actually priced in the cross-section of option returns. And the illiquidity is not as strongly priced as suggested by CDJK. Liquidity is not strongly priced in options as suggested by CDJK. So we try out of these results, compile a list of recommendations of what we can do to prevent these look-ahead biases. And this list that we provide here is just something that we're starting thinking about. And essentially, what we think it needs to be done is that we need to see more of these sharp ratios in papers. So both Zen et al. And Christopherson et al., they actually don't show the sharp ratios of their strategies. And maybe if these sharp ratios were more explicit, maybe we would actually start asking questions about whether there was a look-ahead bias on their results or not. Another recommendation is to clearly describe the start and ending of the holding periods and describe the time that the filters are applied on the sample. And that is important because for anyone that is trying to replicate the studies in the options literature, I mean, this is a very important information for any type of replication. And it's not very explicit in many papers, you know, where you actually apply the filters in your sample selection. And again, thinking about replication, another recommendation is to write the paper, or perhaps the appendix in the paper, thinking about the reader as someone that's actually going to try to replicate the findings. It was a good amount of work to replicate the findings in these papers. It was not very immediate. And we actually had to assume that some of these filters were actually applied in the end of the holding period to get results close to the results in these papers. And moreover, the final recommendation is to apply filters only at the starting of the holding period. And but naturally realize that that's not always possible to do, especially when you have outliers in the data. And so when you have to apply a filter, let's say you have to eliminate option prices that are clearly wrong, and that results in a sample that's infeasible, at least might be important to discuss that the results are robust to eliminating these filters, or to actually at least address the possibility that filters eliminating some of the options in the sample result in changing the results. So these recommendations are essentially based on the idea that there are two biases that are present in this specific case that we study. The first one is a publication bias, which is the idea that papers that have strong results are more likely to be published. And so these strong sharp ratios actually that we observe in these studies maybe would make them more likely to be published. In fact, in the case of the Christopherson et al. Paper, in their working paper, in their first version, illiquidity was not as strongly priced as in the published paper. So something happened throughout the publication process that the results changed quite a bit, and they end up finding very high sharp ratios in illiquidity. The second recommendation is with respect to how easy it is to replicate papers. The fact is that in finance, we don't replicate papers as often as in other sciences. And maybe because we don't replicate papers as often as in other sciences, papers are not written having in mind that readers will try to replicate the results. And that may have contributed to the fact that some of these findings in these papers became stylized facts in the literature. So let's go to details about each one of these papers. So let's start with replicating ZHCT. So ZHCT clearly describe the set of filters that they use, but they don't describe the timing of the filters, right? So they don't describe that they apply the filters in the beginning or in the end of the holding period. And we're not able to replicate ZHCT results if we apply their filters, their sample selection filters, only at the beginning of the sample period, which we call time t-1. So we therefore had to assume that ZHCT may have applied their filters at the end of the holding period in order to replicate their results. And what we do, we look for the combination of filters within the set of filters that describe that when imposed at both the beginning and the end of the holding period would match the results that they have in the paper. And specifically, we find that these three filters over here, when applied both in the beginning and in the end of the holding period, result in samples that give results that are very, very similar to those in ZHCT paper. So specifically, if you select your sample in such a way that the bid prices for both calls and puts are positive at both the end of the holding period and the beginning of the holding period, and the quote midpoint is at least 1/8 of a dollar at both the end of the holding period and the beginning of the holding period, and the quote midpoints do not violate no arbitrage conditions, which results in the fact that we have no missing volatilities in option metrics at both the end of the holding period and at the beginning of the holding period. So with these three filters being applied at both at the beginning and at the end of the holding period, then we get results that are close to those in ZHCT paper. So graphically, what we think is happening in their sample selection is represented here in this timeline. So at time t-1 is the end of a given month. That's where you sort stocks according to a certain characteristic, and you create portfolios of written call options on those stocks. And then we have here a set of sample selection filters, based on close prices at t-1, which is the end of the month of the previous month. And so example filters are that the call price needs to be above 1/8 of a dollar, and the put price at t-1 needs to be above 1/8 of a dollar. And then the holding period is the entire month. So you create portfolios of written call options here at time t-1, and you hold it for the entire month. So the holding period is from the end of the previous month to the end of month T. And this is part of the sample selection that we think ZHCT applied. But in addition to that, to replicate their findings, we also need to impose some filters here in the end of the month, in the end of the holding period. So you have some sample selection filters, such as the call price needs to be above 1/8 of a dollar, the put price at the end of the holding period needs to be above 1/8 of a dollar. And with these filters, what ends up happening is that we eliminate options, call options that become either deep in the money or deep out of the money at the end of the holding period. This is the infeasible sample strategy that we adopt in order to replicate ZHCT findings. Now, we also try to emulate the results with a feasible sample strategy. And the feasible sample strategy only applies these filters at the beginning of the holding period. And what do we find? What we find in terms of just summary statistics, in terms of monthly excess return of writing delta hedged calls, we find that in the infeasible sample, we have these high buy and hold until the month end mean return for delta hedged call options of mean return of a 3.19% per month. Now, this 3.19% per month that we have here in our infeasible strategy is reasonably close to what they report in their paper. So in their paper, they report that that mean return is 3.5% with a standard deviation of a 5.65. And the median return is 3.32% in their sample. In our case, the standard deviation is 6.29%, and the median is 3.14% per month. That's the return that we have in our infeasible sample that tries to replicate their results. So it's a reasonably close replication, I would say. And that's in the infeasible sample. When we try to replicate the results using a feasible sample, the results change drastically, even in the summary statistics. So what we actually find in the feasible sample is that writing delta hedged calls result in mean returns of 0.25% per month. And so this is a very large difference between the infeasible and the feasible results. It's a difference of about 3% per month, which is a very large bias in the mean return. Why these biases are present? To understand this bias, let's just think about how the mean returns of delta hedge call options should look like. And to do that, let's just plot over here the value of the change in delta hedge written call. And so a delta hedge written call strategy has a theta that is above 0. So the derivative with respect to time is positive, and the gamma is negative, the gamma of a delta hedged call. And so if you just use a Taylor expansion, you see that the change in the value of the portfolio for a month be approximately equal to theta times the change in time plus a half times the gamma times the change in the stock price squared. And if you plot these, what you end up getting is a graph like this. And in our sample, what you'd see, many observations that are across this line over here. And when you take the averages of these observations, you'd actually see a true mean that, let's say, is positive somewhere over here. And what happens is that if stock prices drop a lot, the mean return of the delta hedge strategy is negative. And if the stock price goes up a lot, the mean return of the delta hedge strategy is also negative. So essentially, if the call becomes either deep out of the money or deep in the money, you'd actually observe these very large drops in the value of the delta hedged strategy, delta hedged call strategy. Now, once we impose filters in the end of the holding period, and filters that are such that we remove observations that either become deep out of the money calls or become deep in the money calls, once you remove these observations and you take the mean of your observations, what you end up finding, you find a bias. So the mean actually goes up because you're removing these extreme observations. And then you have a bias now on the mean change in value of your portfolio. And so these infeasible filters are removing calls that have prices, only working with calls that have price above 1/8, and puts that have prices above 1/8, end up removing these observations here on the extreme. And by removing this observation on the extreme, you create this bias. And this bias over here, it's exactly what justifies this difference between the mean returns in the infeasible sample and the mean returns in the feasible sample. So it's because essentially you're removing these extreme observations. Now, this bias is not only about the mean returns of calls, but also affect the mean returns of the strategies that are based on sorted stock options. So specifically, when we try to replicate their findings of sort stock and options across different characteristics, we find what is here displayed in this table. So here what we have is the first column is essentially exactly the same findings that they have with respect to the high minus low portfolio for each one of these stock characteristics. So these are portfolios of delta hedged calls, and the portfolios are based on sorting stocks on each one of these characteristics. So you have things such as, let's say, the log of the price at the previous holding period, profitability, Z score, deviation from volatility. So all of these are characteristics of the stocks. And the first column here displays what ZHCT document in their paper. The second column displays what we call the infeasible replication. And the infeasible replication actually has results that, quite often are very, very similar to the results that ZHCT display. Now, there are, of course, some differences, so it's not a perfect replication, but in general, the infeasible sample actually gets results that are very, very similar to what ZHCT replicates. One big exception is with respect to the Z-score. We unfortunately we're not able to replicate why that document is the spread between the high and low portfolios of delta hedge calls based on Z-scores. But with respect to other strategies, they are qualitatively similar results, and sometimes very, very similar results in terms of the actual numbers we get. Let's say, for instance, the amount of issuance of equity in the previous year. They find 1.6% being returned per month. We find 1.62% being returned per month. This is for the infeasible sample. Once we do exactly the same type of strategies using only the feasible sample, meaning using filters only applicable at the beginning of the holding period, the results change drastically. We don't find that these strategies are actually priced in the cross-section of individual equity options. And we find very, very large biases. So in fact, here's, for instance, in this case, in the infeasible strategy, we have a 2.12% per month return. In the feasible strategy, you have minus 0.13%. which is essentially a bias of 2.25% per month return. The T statistics also changed drastically, and the Sharpe ratios dropped from 3.78 to minus 0.21. And this happens across many, many of these strategies. So these large Sharpe ratios in ZHCT seem to be resulting from look-ahead biases. Now, how can we understand this? To understand this, let's think again about the graph that we had in the previous slide. But now, let's draw two graphs. One is for that portfolio of call options that is built on the stocks that have, let's say, a high value for a certain characteristic. And this portfolio is here on the left. And on the right, let's draw a similar graph for a portfolio that has a low value for that specific characteristic. So if in this high characteristic portfolio, for some reason, the filters are such that remove more options that end up deep out of the money or deep in the money, then you're going to actually have a larger bias on the mean return. And so in this specific case, we plotted these figures in such a way that the difference in the true means is actually 0. And so the bias of high minus low is just going to be equal to the bias mean of the high minus bias mean of the low, which is equal to the true mean plus the bias of the high minus the true mean plus the bias at the low. It's essentially the difference on these biases. So the high minus low is essentially difference on the bias in these specific figures because the true means are essentially the same. So if these high characteristic portfolios end up having more observations that end either deep out of the money or deep in the money, then we're going to actually have figures like these, and then we're going to actually have biases on the high minus low return. Now, how come you can actually have across all these characteristics portfolios that have in the high characteristic more observations that end up deep out of the money or deep in the money? I mean, to understand that, you need to come up with some explanation why in these high characteristic portfolios you have more of these extreme observations. And one possible explanation is that in these high characteristic portfolios, you have stocks with higher volatility. So in stocks with higher volatility, you end up actually it's more likely to actually have observations that end up being either deep out of the money or deep in the money. And so if that is the case, there is a relationship between these characteristics and volatility. And that's what we try to see in the data. Specifically, here in this graph, what we see the look-ahead bias that is reported in the previous table. It's essentially this column over here, this bias for each one of these strategies. This is here in the y-axis. And on the x-axis, what we have is the difference in the average implied volatility of the high and low portfolios. And you see a strong relationship between this difference and the bias. In fact, the correlation is 70%. And so essentially what this graph is doing is supporting the idea that the explanation for the high minus low bias is really related to volatility, which is related to this difference on those figures that we plotted here. All right. So before we move to CGJK, are there any questions? I'm not looking at the chat. Let me see if there are any questions on the chat over here.
I'll jump in while we're reviewing the chat. I mean, it's not the first time we talk about this, and this graph is, is very telling. But if we go back to the previous figure, right, the filters that you identify as being problematic are the ones filtering on the price of the option, right? So if those underlyings that you're looking at in the high portfolio are with higher volatility, then we could argue that maybe their options are worth more, and so they will be less often under the 1/8 threshold. So although the correlation with volatility is striking, I think it would be worth showing that you end up in the end filtering out options based on their prices, right?
Right. And so actually we actually do that in the paper. I don't think I have this table in the presentation, but we actually do exactly what you said. And the way we do it, we look at the moneyness of the options in the end of the holding period for both the feasible and the infeasible sample. And so what we find is that in the feasible sample, we have more extreme moneyness. While in the infeasible, we don't. So essentially, we are eliminating these options. That's exactly what we find in the data, right? It's related to what we are saying. Yeah, this is in the paper.
So while you're answering questions, I'll raise one that I deferred. So the question is, or in the chat is, love the paper. Do your results have implications on how to find infeasible strategies beyond these two papers?
Yes, I think that pretty much what we're trying to do with these recommendations over here is coming up with some rules of so where am I? Our recommendation. I'm moving my slides back. Just a minute. So it's essentially what we're saying is that the Sharpe ratio might be one of those red flags. It's unfortunate that when you read many of these papers, it's not really clear when the filters are applied. It would be very nice to know that the filters are applied for the entire sample or not. But I think the number one recommendation is really looking at the Sharpe ratios. So if the Sharpe ratios are too high, that would be a red flag. In addition to that, something that we're thinking about that might be another way to look at this is that in these specific cases, when we look at the summary statistics, when you look at these summary statistics, right, we already find that the mean returns, just look at summary statistics before building any kind of sorted portfolio. We already find very high returns for delta hedged call options. Just it might be maybe an easy way to detect these infeasible strategies in literature could be by just looking at the summary statistics of some of these papers and try to see if on those summary statistics you find something that is suspicious. So before getting the details of how to of actually building these strategies, just returns that they report in their papers. In their paper, the return of 0.32% per day for the at-the-money call options, and the delta hedge returns for puts of 0.14% per day. Now, once we move from infeasible sample to feasible sample, we find a big difference. So in the feasible sample, the mean return of a delta hedge call options is not that large anymore. It's actually just 1 basis points per day. And in the feasible strategy, the mean delta hedge returns for puts is actually negative and equal to -3 basis points per day. So how can we understand what's going on here? So to understand what's going on here, we have this little figure. In this little figure, what we have is the delta of a given option here at time t-1 when they select their sample. And we also have the delta of the same option here at time t-2 here, the close of time t-2. So this sample selection procedure of selecting options based on the delta being at the money at time t-1 end up resulting in a sample that has many more out of the money options at time t-2. Options that are out of the money at time t-2 when the stock return is positive. So the idea is simple. An option is out of the money at time t-2 and the return of the stock is positive, meaning stock price goes up. These out of the money options are more likely to become what? At the money, and so they end up actually being in the sample when the stock return between t-2 and t-1 is positive. These out of the money options, they actually have higher betas. And so they are more sensitive to the stock price movements just because these are out of the money options. So when the stock return is positive, you select a sample that has more out of the money options and have higher beta. When the stock return is negative, on the other hand, it's the opposite. So now you select options that are in the money at time t-2, but end up at the money at times t-1. And these in the money options, they actually have lower beta than out of the money options. So when the stock price drops between t-2 and t-1, you select a sample that at the beginning of of the sample period, beginning of the holding period, has more in-the-money options and has lower beta. So essentially, with this sample selection process where you select options that are at the money in the middle of the holding period, you create an infeasible option strategy that's analogous to an infeasible market timing strategy. And this infeasible market timing strategy is what actually justifies these very large biases on the delta hedged call returns. And an analogous story would go for puts. So this is for the summary statistics, right? So what about when you sort the stocks on effective spreads? What do you find? When you sort stocks on effective spreads, now we have these results. And these are the delta hedge returns, the equal weighted delta hedge returns. And then we have here the infeasible and the feasible results for puts and for calls, and the infeasible and feasible results for puts. And so these are quantitative spreads of delta hedge calls and puts based on sorts of on effective spreads. And so what we find is that in the infeasible sample, we find that the daily return of providing liquidity for calls is 1.52% per day, while in the feasible is 0.19% per day. And so the large Sharpe ratios actually, they go away. They decrease from 10.87 providing liquidity for calls to 1.73 providing liquidity for calls in the feasible sample. In addition to that, instead of just using equal weighted returns, if you also use the gross weighted returns, which is a methodology that we developed in a separate paper to deal with some of these microstructure biases, now we see that in the feasible returns, providing liquidity for calls is actually has a much smaller Sharpe ratio and a much smaller mean return. In the case of providing liquidity for puts, we find pretty much no premium to provide liquidity for puts in the feasible strategy. Now, to understand what's going on here, again, we can go back to our figures where we have the sample selections. And so what we saw is that on days when the stock return is negative, you select more in the money options, options that are in the money at T-2. These options that are in the money at T-2, they also have lower effective spreads. There is a relationship between moneyness and effective spreads, and options that are in the money, they have lower effective spreads. So essentially, when the stock return goes down, you have, for that portfolio that looks like liquid, you have more in-the-money calls on that portfolio. Now, when the stock returns goes up, for that portfolio that looks illiquid, that has higher effective spreads, you have more out-of-the-money calls in that portfolio. And so the look-ahead selection procedure essentially makes sorting on effective spreads equivalent to sorting on these returns. So sorting on effective spreads is essentially the same thing as sorting on the subsequent day stock return, because it's built in on the sample selection procedure that you only have at the money options here in the middle of the holding period. So the explanation for the bias in CGJK is essentially represented here in this figure. So what we know is that higher stock returns, they result in higher delta hedge call returns. And so this is a relationship that is just related to the way that the returns are calculated in their paper. Because remember, in the first day, the returns of the options are unhedged. And so higher stock returns result in higher delta hedge call returns. Now, their sample selection procedure also created a relationship between the higher returns and the moneyness of the options at time T-2. And the moneyness of the options at t minus 2 is also related to the effective spreads of the options at time t minus 2. So as a result, we have this relationship between effective spreads and delta hedge returns being caused because of the sample selection procedure. Once you change the sample selection procedure and you break down this relationship between the next day return and the moneyness of the options at time t minus 2, then this relationship here between effective spreads and delta hedge returns also disappears. Right? So that is our explanation for their findings.
Okay, let me jump in. You need to think about the time.
All right.
You only have a few minutes left.
All right. So pretty much what we have in this table is a summary of what I have just shown in the previous figure. I'm going to skip this slide then, in the interest of time. And let me conclude. Essentially, this look-ahead bias can explain some of the sharp ratios that we find in the literature, specifically in the case of ZHCT and CGJK results. That has implications for the empirical literature in options. The first implication is that illiquidity is not as strongly priced as we have been thinking about. Liquidity is not that strongly priced in options, and not many of the stock characteristics are actually priced in the cross-section of option returns. And so overall, these two good to be true sharp ratios can help detect look-ahead bias in option returns. That's our message. Thank you.
Okay, thanks very much. There was another question in the chat that I deferred. The question was, can we assume then that papers that use strategies in which options are exercised at expiration are not subject to this bias?
Yeah, it definitely would help holding until the expiration, because some of these filters will not be applicable at the expiration. So holding up to expiration would definitely help.
I'm wondering if it helped with the CGJK paper, though.
Yeah, it's CGJK paper, that is daily return, and so that is intraday, and so it's a different story, and that would not help, right? Because we're doing these daily returns. In ZHCT, they also have some returns where they hold the options up to maturity. But then, even when they hold the options up to maturity, if their sample selection procedure removes options that throughout the month become deep out of the money or deep in the money, we still have the bias. And so, holding to maturity helps as long as you're not applying filters on data that is not available at the portfolio formation period. And so that is pretty much the same. I think the best way to summarize it, right? Try to apply the filters only at the beginning of the holding period, not after the beginning of the holding period.
All right, so actually at this point, I should like to invite anyone who has a question to unmute yourself and feel free to, use your microphone to shout out your question. There might not be many because it seemed like a very straightforward paper, but if you do have a question, now's your opportunity.
I mean, on applying filters at only the beginning, right? You know this data much better. How often do you see that at the end you just don't observe option prices at all?
In the option metrics data, not very often. In the CGJK case, it happens more often because in CGJK case, essentially, I mean, the way they build the procedure, the options need to be traded both at time t-1 and time t. And not having options traded every single day would actually remove the options from the sample. But in the option metrics data, we actually normally see the options in the end of the end of the months.
Jefferson, so as you kind of highlighted in your answer to Pedro, discussing the illiquidity paper is important because it kind of discusses a slightly more subtle mechanism in which you kind of introduce the look-ahead bias. And that's, very important. And again, I'm still trying to think about the bottom line result where you say, well, if we do things correctly, illiquidity is not priced in option markets. And so the kind of knee-jerk reaction to this is to look at the sample that the original paper was covering, which included the financial crisis, and to look at your sample, which ends up just before COVID when money was free, and say, well, maybe liquidity was, not much of an issue during those years. So how do you what's your stand on this?
And so let me tell the story regarding the sample. We actually bought this data a long time ago from LiveVol. So we actually have data starting in 2004. And then when we start working with these, we noticed that there's so many outliers and there were some issues with the sample, went back to CBOE, and then we found out that they stopped selling that data. And so the main results in the paper are based on a different sample period. But in the appendix, we actually do results with exactly the same sample period as CGJK. We find results that are qualitatively the same as theirs, and we find results that are pretty much identical to what we are finding in the main paper. But it's not exactly the same. It's not an exact replication because there are so many outliers. The reality is that the early sample period, there are many outliers. And in that procedure of selecting only options that become at the money in the middle of the holding period helped a lot in removing those outliers. And so I think the answer is no, it's not because the sample period that illiquidity is not priced in options.
Neil, this is Blair Hull. I've got I have a comment about supporting the paper. I spent 2 years trying to implement this strategy with about $10 million of a cost. And I found that this strategy is extremely difficult to implement and to make any money at. So I can confirm in the marketplace that at least my attempt, even using some sophisticated techniques like gradient boosted regression trees to get information out of this that would be predictive of the hedge gains on options, that I failed at it. So I'm just giving you a practical application that supports your paper.
Oh, thank you. Thank you very much. And so a question for you, Blair. Which one of those strategies you try to replicate? The one that is the cross-section of the options or the illiquidity?
We actually had pieces of both of them into our regressions that tried to predict hedge gains. So we were trying to predict hedge gains to as short as a period as 5 days too. So we it went 63 days down to 5 days, and we tried to predict hedge gains based on all kinds of factors, including forecasts of volatility. So it had pieces of both of them.
Thank you.